Assalamualaikum warahmatullahi ta'ala wabarakatuh. So, the various financial products and services have been developed in meeting the consumer's needs. There are two main categories of these products and services, which are long-term savings products and non-saving products. Based on this statement above, identify and explain the nature of four most common long-term savings products in Malaysia. So, before we move to the main topic, I will start with the introduction. Basically, long-term saving accounts are designed to hold money that you don't expect to need to spend in the near future. They are different from short-term savings account or checking account that you might use to set aside money for bills and upcoming vacation, wedding, or other one-time expense. You can have a long-term savings account at a bank, credit union, or other financial institution. Some may charge monthly account fees, have withdrawal limits or penalties, and other rules to follow. In a nutshell, the primary purpose of long-term saving is to secure a comfortable retirement in future. So the first one is the traditional life insurance savings product. In exchange for a lower premium payable for a fixed term, this product generally pays a sum assured at the end of the policy term or on the earlier death of the insured. These products are often with profit or participating, meaning that they show in distribution of profits allocated largely at the discretion of the company. Where traditional policies share in profit, the using mechanism is to add bonus to the sum assured. Often bonus are paid in cash, which is in terms of dividends, and used to reduce the premium. There are three main forms of traditional saving policies that are offered, which are endowment insurance, per-endowment, and deferred annuities. Endowment insurance pays the sum assured on death or on survival to the end of the policy term. Meanwhile, per-endowment pays the sum assured on survival to the end of a fixed term and usually give a return of premiums with interest on earlier death. Lastly, deferred annuity pays annuity when the annuity reaches predetermined age. Today, many versions of this contract cooperate with the option to take cash at maturity rather than annuity, effectively making the primary and investment product. The next one is superannuation funds or non-expansion or provident funds. Superannuation funds are saving vehicles established for the purpose of providing lump sums or pensions at retirement. These reflect the continued growth in living standards, the increased length of healthy retirement, and the tendency to treat superannuation contributions made by the employer as deferred pay. In most countries, savings via superannuation funds has that advantage, generally in exchange for constraints such as limited access to the money before a reasonable retirement age and the requirement to take most of the benefit as annuity. Many funds internationally provide this regularly to the employee land of the survey and his or her retirement. Defined benefit funds usually also pay benefits on death, disablement, early retirement, ill health retirement, resignation, and redundancy. From an employer perspective, the value of defined benefit fund is that the employer takes the risk that extra contribution will be required to meet the promised benefit. Many employers now treat superannuation as a form of deferred pay. For the same level of contributions, a defined contribution structure can be expected to support higher resignation benefits and lower retirement benefits than a typical defined benefit structure. So the next one is investment-linked arrangement, in which a variety of products have been developed in more recent times to give customers access to the investment performance of asset portfolios. One of the products called unit trusts are legal trusts that pool investor interest in assets determined by their constitutions or trustees. Investors participate in the trust by means of units, which define their share of the trust. Units are frequently revalued and may be sold back to the trust at the market value of the underlying asset. Listed are closed trusts, which are called investment trusts in some countries, are bought and sold on the stock exchange at price that might differ from the underlying value. For both types, there are predicted distribution of investment income, and this must be reported in the real estate tax returns. And finally, the last one is investment account policy, which are more like bank deposit and capital guaranteed rather than unitized. Interest may be predetermined or like bonus can be carried to the policy on the basis of profit earned by the life insurer from time to time. Over the long term, the policy owner can expect to receive a rate of return equivalent to that earned by the supporting asset, less fees, taxes, and exchange offer the capital guarantee. And actually that's all from me. Thank you.